This is my first event since the tech world almost blew up, so I'm certainly going to ask that. We've had an extremely dramatic period. I feel like we had a super rough 2022 in tech world, and then seemed like this year was going well. Microsoft was up, I think, 10% this year. Salesforce is up, and then Silicon Valley Bank almost exploded, and I think that's created a lot of fear. So we'll have a ton to discuss. I think, early stage valuations, what's happening with generative AI. I think there's a lot exciting going on, good and bad. For a little context, I'm Eric Newcomer. I was a Bloomberg reporter for 6 years, and now I write the newsletter Newcomer. It's about startups and venture capital. You can check it out at newcomer.co. I focus a lot on the funding environment. I'm writing a lot about generative AI right now. Yeah, that's me. Anyway, do you each want to give like just 2 lines, who you are, where you live, what stage you invest in?
I'm Robbie. I'm a seed investor at Cowboy Ventures. I'm usually based in San Francisco, but I love coming to New York and doing awesome events like these.
You heard enough from me. John Lair, Workbench, $125 million seed fund.
Hi, Samil Shah from Haystack, based in the Bay Area, but try to be here 3 to 4 weeks a year, maybe more.
All right, I want to talk about Silicon Valley Bank. I don't know how much you guys do, but we're going to briefly at least talk on how scared were you, Friday when this all sort of went down. Like, somebody just give me your emotional journey on this Silicon Valley Bank thing, and then where do you sit now? I'm going to throw it to whoever's brave enough to take this on. One of the California people has got it.
Sure. So I would say for Haystack and then our personal family finances, they were inadvertently spread out way before. So we just had tons of accounts. So I didn't feel stress personally, but a lot of people around me did. And so it was a really interesting, unfortunate psychological experiment or situation where everyone's just expressing whatever genes they have in the moment of trauma, basically, or the fear of trauma. So I felt like it was incredibly distracting, and a lot of our fundraising conversations that we had in addition to this trip is sort of just pause and have to reset. But in that moment, it felt very jittery. But again, I didn't feel extreme stress myself, but I felt it all around.
But you're saying fundraising conversations have stopped because of it?
I think it was just hard to, any conversation we had kind of ongoing, it was hard to keep that going. You'd almost have to reset and say what is your name again? What do you do? Who am I? Kind of thing.
Right. It's so disorienting. It's we forget what was your take on it?
So I'll actually take the counter where we were heavily impacted, both from Cowboy Ventures perspective, that was our bank. 60% of our companies were either solely at SVB or had a majority of their capital there. So it was really anxiety-inducing. And I think the thing that was tough is no one had strong information, or they had light pieces of information, but there were a lot of people who represented themselves as knowing what was going on. So it was hard not to try to do a lot of digging, whether it be Twitter or news outlets, to try and get certainty, but then knowing in the back of your head that no one really knew what they were talking about. I think it was just an information search exercise and trying to find ways to help, even though the paths were super limited.
One note on the portfolio is we took an approach to tell the companies that asked us to wait. That wasn't based on any information, but we felt what is the cost of course you should do a contingency plan, but what's the cost of over panicking?
Wait on moving their funds, or wait on?
No, just obviously build a contingency plan, but wait to see what will happen Monday, because there was going to be some type of resolution by Monday. Yeah.
Has New York been insulated from this, or it's Silicon Valley Bank? Do you have a sense of if there is a real mixed difference in New York startups banking with?
Yeah, so I'd say
banks?
when you talk about New York City as a whole, you could walk down the street and no one knows what the hell's going on. And that's why I love New York, because tech is still a minority here. Anyone that's in startup world in New York, basically 80% use SVB. So, for us, the one-word description was just whiplash. It was, hey, how much is on balance sheet versus off balance sheet for SVB? We got pretty tactical with our companies, getting those contingency plans in place. And I guess the one other thing I'll say on is working through the weekend with the companies, we're pretty hands-on because we have a concentrated portfolio. And for companies that were Series B or C, you saw people that had never been around all of a sudden call in and say, hey, I got your back. And then you saw people you thought were getting your back that were like, oh, sorry, I have no money to help you make payroll Monday. And we don't forget that when we guide companies to raise in the future, and our founders certainly will not forget that.
Yeah, it definitely sort of separated sort of the sane voices and the lunatics a little bit. I thought, personally, I would say that YC, in terms of like public messaging, represented Silicon Valley super well, and I would say some of the all-in people like lost their minds over the weekend, but they got the result they wanted. I mean, now that deposits are covered, do you think we're out of the clear? We can go back, like, for the rest of this conversation, are our narratives just going to be where we were in the first couple of months, or, you know, and SVB may be the safest place to keep your money now. You know, they're guaranteed by the government. That's certainly the pitch they're making at the moment. But, you know, they were a super important lender. You know, they did all these, you know, they gave personal loans to like founders and VCs. I don't know, just with SVB so disrupted, does that derail any sense of narrative for the year that we had before? Or do you think we're safe to go back to what we believed before this crisis?
Yeah, I mean, just one guy's opinion. I think it's too early to tell. If you asked me what's going to happen Saturday, I would have told you something. Sunday, I would have told you something else. Yesterday, I was getting all these texts from founders, like, we're moving back and we get a line of credit. And today, I haven't even paid attention, so I don't know. I feel like it's unknowable.
What I'll say, and I'll speak probably for all of us, is last week obviously was whiplash. We're trying to be totally back to normal, and I mean, we did like 3 different fundraising pitches today. So back to obviously there's contingency plans. People have to figure out what's their new treasury policy in terms of cash and whatnot. But for all the founders in the room, I think
one bit of a little nugget for you, a newcomer, is you know, a number of big platform funds that shall go unnamed, but you can guess, already sent out capital calls today. And so those were sent to
LPs, or
yeah, to
because
SVB.
like I know, for instance, I think Andreessen told their LPs like, stop sending us money. We need to like figure everything out.
Yeah.
And so now you're saying some of the firms.
I won't name any firms, but they're saying a bunch of them are doing the capital calls today. They have 2 weeks to subscribe or call them. To SVB, some are offering an option of SVB and Citi. So even the big firms are, you know, figuring that out. So
And if you're a startup, this means you need your VCs to be able to get their money so they can give it to you. So it's sort of, you need the LP to flow to the VC.
And I contacted a bunch of LPs today, and I asked them just point blank, would you wire today to SVB or FRB? And the response was sort of mixed. Over the weekend when I asked, they were like, yeah, we probably would. Today it was like, we're not really sure yet, but the crunch comes at the capital call. In 2 weeks, there in the LPA documents, like you have to pay your capital call. Yeah.
Right. So that certainly looms very large, and I'm sure we'll touch it again. I mean, I want to talk a bit about just like the spaces you're interested in, and to get into the technology, because obviously you still want that to animate your year. I mean, what are the areas for each of you, just sort of going down the line, where you're particularly focused right now? Like if you're hunting for companies, I mean, I'm sure you have a long list, but if you had to keep it to, at best, top 3, where are you looking at the moment?
I'll make it easier. I'll just highlight one. So what we've seen the last, call it like 6 months and continuing, are just extreme budget cuts and budget shrinking. And the one area within enterprise that has continued to have good budget is in security, because attackers don't care that there is a recession going on, and they're not going to stop going after the growing space that companies have their data accessible, whether it's through vendors or using more freelancers or growing their teams and adding more access. So we're spending a lot of time in security. There are actually still like 700,000 cybersecurity jobs in the US. And like around the world, it's millions. So we're looking at a bunch of different tools in security, whether it's helping with like software bill of materials, things around API security, and that's kind of the general area across my focus areas, which are all in software infrastructure that we're spending time on.
Great. Cybersecurity.
So at Workbench, we have 4 key pillar areas: AI, ML, cybersecurity, cloud native dev tools, and then future of work application layers. So if I just pick a couple, security is obviously top of mind. We've been looking at it from more of a consolidation perspective, where it always ebbs and flows from features to platforms and then consolidating around more of the big dogs. And there's more attackers than ever, but there's also tighter budgets. So I think on the margin, CISOs are wondering, how can I extract more value out of existing investments or get a better view to my security posture? So we're looking in spaces like that, as well as just new attack vectors, kind of like what Ravi's saying around new security architectures that might be needed. In terms of the dev tool world, all of us on the panel do a lot in open source together, but figuring out where's their actual business models for some of these projects to actually solve enterprise pain points at scale is always the push and pull. And it's interesting, earlier Ustin mentioned Wasm as enabling technology for his company, but some stuff like that might be almost like 2-3 clicks away from commercialization, and therefore for us as seed funds, we need to straddle that line where they could get enough proof points when we do a deal, also being able to raise a Series A, which is a topic we should cover. So we're looking a lot at the workflow layer, and then in MLAI, obviously there's a million generative AI, LLM stuff. We're trying to figure out, can you make a tooling play for the enterprise that's not subsumed by a bigger platform?
Yeah, I don't know if this will be like a satisfactory answer for people, but the truth is we're sort of agnostic and we end up in a lot of these categories, but we're really driven by meeting interesting people. I think what gets us excited is really high authenticity of the founder, or like a spikiness in their background, and something that just looks and sounds different, because a lot of things can start to look the same after a while. So we approach it kind of a different way. Try to.
So I'm extremely excited about generative AI right now. Chat GPT-4 just came out. I'm amazed that I'm able to shift my brain to enterprise world, because I've been living in the chat bot. I've been like trying to teach it all day to have different personalities. And, yeah, it's been a blast, super interesting. I recommend everybody play around with it. I mean, broadly for generative AI, the struggle is just like, is OpenAI going to eat everything? Are the Anthropics of the world going to dominate anything? Is there room for an early investment? And then especially if you're trying to have more of like an enterprise focus, are you really going to be able to cobble stuff off? That's like the negative. The positive is, I think there's also a view that it's like, well, we can reinvent every SaaS category. It's like, oh, I will apply generative AI to this. I will apply it. So yeah, where do you tend to sit on that spectrum, and what are you seeing right now? You seem very excited.
I think that there are like 3, or depending on how I classify this, 4 buckets I think about this. And generally, I think it's very hard for smaller funds to play in a lot of those buckets based on like how those are raising. But there's the LLMs. That's a whole thing. And we could talk about that.
OpenAI, Anthropic.
Yeah, and I think there the logic is that, will every Microsoft have their own OpenAI? And a lot of people who are inside the C-suites of these big tech platforms and the chip companies believe that will likely be the case. And so that might be the rationale for why the large VC funds are plowing tens and tens of millions of dollars into these, because you have a limited set of people who can do it. You have pain point at the big platforms and sort of willingness to pay. So that's the bet there. Another bucket is the generative stuff and the synthetic media and the creation and all that stuff, and that's super exciting. And I don't think we even really know yet what's going to happen with that and where it's going to be. I mean, it's really, really cool. I have no idea how it's,
Well, you have like Runway is a company I'm obsessed with, where they're right now it's like sort of it's like a Adobe Photoshop for video, but it's sort of like, if it helps, it'll be great. It can try and create something. If it doesn't, use the irregular tools. Clearly, the CEO wants to be able to like generate AI videos, which would then be insane.
And so I don't even think we're in the first inning of that, right? We're just about to start the game. Another one is just straight up vertical, AI. So people would say, okay, there was Viva for software in the pharma space, and so what's the vertical AI version of that? And then the final one I would say kind of splinters, where it's like, okay, you have a product with distribution like Notion, where if you're a paying customer now, you can go in and you get AI as a surplus. Or it's like the next meetings app that takes all the ingredients from the meetings. Maybe that becomes a new AI-driven thing.
Well, right.
So I think of it in like floor classification. Then final comment I would say, for most seed funds, I think they can only really play in a couple of those. Not really, definitely not the first bucket.
Right.
Yeah, I completely agree. I think one of the questions that we're constantly asking ourselves looking at generative AI companies is, why does this startup have an advantage over an incumbent that will have a ton of data and resources to put behind generative AI applications? And we've actually, like the area we probably spent the most time in is on the application layer. And what's really tricky there is you'll have, let's say, a marketing application, and then all of a sudden HubSpot announces their chat interface to all of their data, and you're at a complete disadvantage because you don't have access to the same data. So we're constantly asking, like, how does this startup have an advantage over incumbents that have all of this data?
We call this like how many miracles, right? Because I think when we're investors and we're meeting, entrepreneurs, we kind of say internally when we're talking, like, we can underwrite one miracle, but what you're talking about is underwriting multiple, and that becomes really, really hard.
And you've circled around this problem where it's like, if it's Notion or like Quora is announcing products, and then super late, Google is putting AI in everything, then even these like startups are competing with your very early investments. It becomes hard to believe in the new.
The other
new
thing
one.
people aren't really saying is what's exploded is the generative text and imaging and a little bit of video. But people were working on AI years before this, Runway being one example. So it's hitting now, but only one of those buckets is really hitting, two. But people were working on the other two before.
And I think what's important in the audience to realize is the point you made about fund size as a seed firm, the type of investments we can make. The other part is you're founder driven, we tend to be thesis driven, and we use the analogy of kind of the cloud wars where you've got AWS, you have GCP, you have Azure. Sorry for bringing up an AWS. But right, when a startup comes and pitches, it's always like, hey, is this something that could be a wedge that's different from them? Is there a need for, so to speak, multi-cloud, which in all honesty hasn't played out so much in terms of under the hood, one app being able to touch both. So, there's people thinking about multi-model. Is that going to be an analogy here that could play? But just make sure when you're, for any startup in the room that's looking to raise seed funding in this space, you need an angle of differentiation, and then how the Notions of the world, the HubSpots of the world are going to kill you, and of course the big dogs too.
There's HashiCorp. I also do think like the surplus piece is something I think about a lot, where it's like, we basically Haystack runs on Notion. We use it a lot, and we get it as a benefit. So it's just like extra oxygen to us, where we don't even think about paying for it. So who pays for it? I don't know.
Sorry.
One quick thing I'll just add is, at Workbench, we're very customer focused. So for the last 7-8 years, we've run a quarterly machine learning roundtable. We have a lot of executives from Wall Street banks, big pharma companies, media. And I remember when deep learning came out, we had a whole discussion around it. And sometimes we'd bring in, we had some guy from Google talk to all these execs about what's possible. And you would see in the news all this hype. You can do X, Y, Z that you never could before. But when you think about it from the enterprise context as a buyer, on a Wall Street firm, they've trained these regression models for years and gotten 94% accuracy. And, deep learning may get you to 96, but at what cost? At what infrastructure? At what other resources are you going to need? And that trade-off doesn't on the increment become worth it. Here, with this hype, what are the net new use cases? And this is where I'll be the first to admit I'm not the most creative person, which is why I don't do consumer tech investing. So what are new capabilities? The same way, GitHub has Copilot. What are new things that could just never be fathomed before? Kind of like with Runway,
right.
but are going to touch
you have like
stuff.
Cohere trying to help big enterprises use their data to make their own sort of models that are interesting. I guess to move this towards sort of like a valuation question, especially at the rounds you do, it feels like there's this huge disconnect where you have the generative AI rounds, which are like, forget everything we learned in 2022. It is like still 2021. We're like having a party. You can like make momentum investments. Like feels to me like there are people who just like love momentum investing and found an excuse to keep doing it. But then on the other hand, like I feel like SaaS multiples have like been destroyed, come back a little bit, but like Snowflake is still way down, and that felt like the anchor of like all this SaaS investing. So yeah, how do you square generative AI multiples versus SaaS, and then shifting it to focus on SaaS? Like where do you see SaaS multiples right now?
Yeah, I would probably like redo the premise of that, because I think on the LLM side, it's a technology investment where it's not really based on any multiples. And so there's some labor cost associated with those people, compute cost, and then just war chest filling, right? That's happening.
There were SaaS companies in November 2021 that had no revenue and raised $1 billion valuation.
Now the problem And there was just one today, with 3 million in revenue done at 750 post in this space. So
In generative or SaaS?
kind of in like the database that sort of supports those things. You'll figure it. You're good. You'll figure
Wait,
it
what
out.
were, say the you said numbers. What were
He's
the numbers
very
you
good,
said?
so I'm just giving him little breadcrumbs here.
What were the numbers?
3 million revenue, 750 post.
Wow, yeah. Aspire to that. That is.
Yeah.
Yeah.
But in SaaS, I think, and I'd love to hear, Robbie and Jonathan also speak on this, but my view is early, the founders, because there's so much seed capital and because you can't really price based on revenue, maybe even at the A, it ends up becoming like how much dilution and and how networked are you to get enough money and how many people do want to back you. So it really begs the question of what's actually the money round where you have enough data points and de-risking as a capital allocator, and there's enough room to run. And I think a lot of the bigger funds are just like, oh, I'll just wait, right? And so seed funds have to be very careful around that kind of entry point.
Yeah, I totally agree. And one thing that we think about is, from a founder's perspective, you want every round to be an up round, and you don't want to be suffering from a ton of dilution throughout your fundraising journey. So internally we say, okay, you have to at least, but hopefully more than this, but you have to at least be able to 2x your valuation. And as you get out of the seed zone, then you start getting valued on revenue. So if you're raising at a 30 million post money, and so your next round you want to be at least 60 million post money, like can you get like beyond 6 million ARR? And I think more and more the Series A is becoming a really tough round. Like the last few years, we were seeing Series A's that were like $1 million of ARR at 125 million posts. And I think like that is going to start getting hit, and there's going to be this kind of swath of seed companies that aren't going to be able to raise up rounds because of that reset.
Wait, what do you think the classic Series A price will be in July?
Oh, that's a really good question.
To put you on the spot, I know that's not easy, but what's your guess?
So my guess is a projected path. Like let's say you're expecting to end the year at 10 million ARR, then a 10x on that.
I would say, building off what you said, this is the biggest issue I had in 2021. People weren't thinking long term. You may have a valuation in the short term that's 100 at seed or A, and then 500 when you're at 3 in ARR, but you haven't exited yet. And for people that you always have to work backwards, you can't skip steps. At A's, I'll give you a number right now. A's are at 10 on 40s or 50s. They used to be 15 to 20 on 75 to 100 for most companies, forgetting the crazy outlier. And if you work backwards on Robbie's point around 2xing, right now, if you're pricing over 20 in a seed, you're pricing to perfection that not only does a VC at the A have to like your market, be interested in the team you've built, you have to hit enough traction points. Now, for open source or security or ML, it's different milestones, which we can talk about, but if you don't hit it, then you're fucked. And people get too eager to minimize dilution early, and we actually have a calculator that me and Kira are going to publish, because if you work it out through the Series B, being a little bit more modest and mindful of the long game early pays off once you're more in execution mode. And to Robbie's point, you then have the data to support different multiple arguments, and FOMO can come in and price stuff up.
One comment just to something that Robbie mentioned is, and I think sometimes founders get tripped up on like, we hear this all the time for years. Once I get to $1 million ARR, I can go raise a blah, blah, blah. And the reality is it's actually, time is a vector in that. So really what the larger investors want to see is, okay, how long did it take you to go from 0 to 1 million? How long can it take you to go from 1 to 4 or to 5? And so really it doesn't matter if you reach 5 or 10, it matters how quickly you get to those things. And so there's a lot of data people can look at and say like, okay, look at like public technology companies that have like sort of leveled off now, and what was their ramp early. It follows a very clear pattern.
Yeah, and I mean, the only other thing I'd add on to that, which I totally agree with, is it's the speed, but then also how much it costs you to get there. Because if you burn 5 million to get to 2 million ARR, or you burn 20 million to get to 2 million ARR, that makes a huge difference in the eyes of investors.
Yeah, and I remember, years ago when I just started investing, a lot of the VCs who were mentoring me were adamant, now this was a different time 10 years ago, of like, if they were looking at a founder kind of raises 10 million Series A, right? That's what they want to write, that $10 million round. And the founder raised, more than 3, give or take, they would sort of wonder like, okay, like, because they can't benchmark how much you did with, to your point on how little capital. And so that could easily come back too, right, as like a test of efficiency.
One other nuance, just to add in that I realized we didn't cover is when we're talking about, hey, don't overprice at the seed, and then the A is going to come in that range, or at the B. A new investor, if you're priced too high, it's a lot harder for them to come in and go flat or lower, because they know that the existing investors and the team are going to get crammed in. There's like political capital involved, and there's just an emotional component versus kind of a cleaner up round deal. So if you raise a little bit less at a more modest valuation, even if it's a slighter bump up, it's always easier to go slightly up than down.
I mean, to vocalize the founder point of view, it has often been VCs want to keep the valuation lower. Founders are like, I'll let the market speak. If the market speaks this round, the market will speak next round, and I'll be fine. I think the thing that changed, which you guys are clearly attuned to, is that all the investors sort of shifted into the earliest round. So you might be able to raise at a premium valuation in seed and Series A, less Series A now, I think I'm hearing. But then by the time you get to Series B, it's really much bleaker, and so you need to bite the bullet now so you have room in the future. My new question is just, where does seed net out? Like, is it always going to be just like a premium at seed and then bleaker? Because if Coatue and Sequoia are like fighting aggressively in seed, then like, where are we?
Yeah, it will be that way because we've gone through an era where people would literally take $60 million, I always use $60 million, and literally light it on fire. So it's either been lit on fire or it's stranded in some company with like no product market fit. So I think they're basically just sort of resetting by saying, if I let Johnny, who just joined the fund, rip a $3 million check into something he likes, the worst that happens is that Johnny loses $3 million, right? And so you can contain the bleeding that way. And I think it will stay that way for a while, right? Because people have to reset, and then these larger firms will have people and they'll let them do $1 million, $2 million, $3 million checks, and someone who emerges from that, they become, they grow. Yeah.
I want to throw a New York spin on it that's different. So in the Valley, those option calls, small checks from a multi-stage firm are quite prevalent. Here in New York, what I find is actually that happens at Series A. So you've seen the news the last couple of years, all the big firms are opening up shop here. We don't see them at Enterprise Seed. The reason is they don't have enough resources here to do it right. They're not on the ground meeting the operators here early, and to them, they'd rather wait for the A when there's more proof points and let people like us do it at seed. So that's definitely an edge that we feel on a daily basis in New York.
The second half of the year, do you think the funding environment will be better or worse? You have to commit to one of those.
Well, I would say for VCs, the second half of the year starts in September when school starts again. I think we, one person's viewpoint, we're meeting tons of really great entrepreneurs. Most of those entrepreneurs they're not waking up thinking about macro or budget tightening or bank crises. And so I think the flow of those people, whether it's New York, Bay Area, we live in the best places in the world for that. So I don't see that stopping. And to your point about the seed market being vibrant, if that's the place everyone wants to hang out in the pool, that's the
Again, is this a very optimistic no or a very...
No, I'm saying yes, it'll be better than it is right now. Yeah. But it'll be great in seed, but it won't really be great elsewhere because we've gone through a 5, 6, 7 year period where the funding round wasn't a checkpoint. It was a competition.
Right.
And now it's actually really a checkpoint. And so culturally, investors have to relearn that if they've ever learned it before and forgotten. And founders, it's just a whole different world. Things that they've been taught from blogs or, do your fundraising this way, or other founders helping other founders, right, when they've only raised one capital once, that's going to be trial by education.
Does anybody disagree, or are you both?
I'm a strong yes on getting better, like very strong. I mean, to us at least, 2021 and 2020, well, 2021 was a shitty year, right? Money was flowing for all the big firms, but for us as a thesis-driven firm, We like to get to know people. We then try to not have them skip steps, like I just said before. And there was just so much money that was coming. So that option call I referenced of like a $3 million round actually was like a 7 or 10 million that we couldn't compete with. And to your point, founders are kind of getting, starry-eyed and took it. Here we've got the thriving ecosystem. We've got people starting to leave Datadog, Mongo, Braze. I mean, Ethan's over there. He just left Mongo a few months ago, and we got to spend 6-7 meetings with him over the course of like 6 weeks. It would have been in 2021 time, like he comes in, he smacks me, he's like, give me my term sheet. We got to know him and build conviction here. So I think it's only getting better. And on the enterprise side, again, this is the NYTM, the pain point is real. I mean, I was at Morgan Stanley in IT at the tail end of the financial crisis where, the world is dying, budgets are shrinking, layoffs are happening, tight end budget. That was when startups thrived. That's a key piece that people don't realize. We had to do an analysis to say, oh, IBM, that mission critical database, cool, we keep it, but for that next use case for fixed income, we're gonna work with a startup, pay $100K, get in-memory capabilities that IBM can't give us, and save $1 million there. So it ended up being a win-win, and we're gonna see a lot more in this environment.
So I will say, well, I'll start with the negative. I think it's going to be worse for growth stage.
Me too.
Because I think that there's going to be a continued contraction of budgets. There's going to be a lot of renewals that don't happen for some of these companies. And they're going to find out that their tool maybe wasn't as mission critical as they thought. I do think for seed, it's going to be much better because for people who work, very talented people who work at these late stage companies, they're suddenly going to look at their options and say, this is not worth it. I've had this idea brewing for a while. I actually am much better off than going and starting it now. So I think we're actually going to have like this surge of really awesome early stage seed companies, but I do think that the growth companies are going to really feel it.
Right. I mean, we had an unprecedented level of $100 million rounds that it takes a long time to burn through $100 million, especially if you're like the wanderer category where you're trying to figure out your product market fit and trying to save all that money. We just had our sort of, .com bubble level event with a bank, the core startup bank blowing up. After .com, it took years for startup funding to recover. It was like a slow fall off. I think the private markets are much slower to react to public market valuations. Rising interest rates lag. It takes a while. I was talking to Lawrence Tosi on my podcast, and he was saying that GDP falls after these, 2 years later. It's like you feel there are lagging effects. I get the point on startup funding, and there's always the case that more layoffs, the better quality founders, you guys are going to take more time with them. I get that, but I think the market is worse.
And I agree with everything that was just said. If I could tie together, I love your positive spin on hey, the opportunity for all the founders in the room is the opportunity that you articulated. And this sort of toggle between seed and growth, or if you think about it, checkpoints, for founders who can offer something compelling and show their grit, hustle, product chops, whatever attribute they have, they'll get $2-3 million because the ecosystem is flush with cash. After that, the clock starts and the checkpoints start, and it's going to get gnarly. And it's going to be a type of fundraising we're used to because we raised our own funds, and that's a pain in the ass. And we've done it for a long time, but then you become there. I'll meet founders, and they're raising $1 million, and they're like, oh, it took 2 weeks. I can't wait to get back. And I'm like, oh, well, I sort of bite my tongue a little bit, but it's going to be hard. And so people are going to, a lot of people, I think once they start to go through that first real checkpoint, honestly may tap out.
We'll open it up to questions soon, I think. I wanted to ask, given we've had this situation where seed rounds are a little more premium and then there's trouble ahead, for your startups that aren't making the inflection to the next round, what are you doing anything for them?
Yeah.
Are you recapping them, or what's the playbook you're running for the startups that get stuck?
I'll give a generic answer, but obviously it's very specific. But my philosophy, one person's philosophy, if you raise kind of $4 to $5 million out of the gate, and you do, it's not about effort, but if you don't have much to show for it, then it's time to go home. And so I think a lot of people get in this, it's sort of like when you're in college. It's like, oh, I'm in college, and I don't know what I want to do, so I'll go to grad school. Right? So I was around, maybe, actually, may not happen.
Does that mean you want them to give the money back when they make that conclusion, or you're saying play out that money and
Our
see?
approach is not no, they should, it's their company, they have agency over it, but we do remind them if they raised a little bit more than we would like and things aren't moving, to be like, hey, how are you valuing your own time and energy, right? Because that's a finite resource.
Yeah, and I tend to agree where if you have raised 4 to 5 million and you've been at it for a couple of years and you're not taking the signal from the market that it's not working, then you're probably stuck. We've had a lot of actually really successful companies come out of pivots, and for those founders, they've really been self-reflective on like something's not working, and then they turn around and can take the capital and do something else. We are all for that, but that is something that usually doesn't come right as you're running out of capital and you're like, hey, not working, I need more capital for this new idea. Like, you probably kind of missed something along the way.
And that actually reminds me, just real quick, of a quote one of my mentors said, who's been around startups for a long time, been an investor, founder, and he just said, if you know early, I love this quote, if you can't be number one in the market you're going to be in, you should pivot. Always have a goal for being the number one thing in your market.
So the one nuance on your question is it's not a surprise at the end. What I love about all of us panelists here is we're all pretty hands-on with our companies, and it's not like you're going a quarter and not talking and then magically $4 million is gone. There's a conversation throughout around milestones, how they're doing, how they're feeling, and we all empathize. Like, do you feel it's here? Are we all seeing the signals in the market that we were just a little slow at the gate on product development, we were slow on this hire, but it's actually here now? I mean, one of our best companies ever almost went bankrupt like 3 times, and now it's multiples of our first fund, and we've had some that were hot out the gate that kind of went flat. So it's situation by situation, and really just working with the founder and being there.
The other reason we try to persuade founders to raise less is actually we view the shorter checkpoints as healthier. Right? So if you have kind of 3 years of runway, just to use some round numbers, and then you're just checking in with your investors become like family. What do you do to family? You tune them out. But you don't tune out a new family member.
Yeah, I mean, that's the beauty of the venture capital model, that it's staged, and it does feel like we sort of lost track of that it's, you have to earn each round, and you fight for it, and you don't raise so much money that you can disappear.
The difference between if Jonathan and I start a company, and then in 2 years we know within that time we have to fund a versus 3, it makes a huge difference in terms of our urgency.
All right, should we open it up? I'm sure there are lots of people on the ground who have better questions than I do, so excited to hear. Yeah. Who's running? Am I running around with it, or?
Do you want to just repeat it if you could?
Oh, okay. I'll repeat it. You just say it.
Okay. We build boring enterprise software. There's no AI. It just makes work more productive. What's your view of this rush to AI, where you've got all this amazing technology, but you've also got all this competition versus doing the simple stuff?
Right.
Better?
What about classic enterprise, not selling some flashy AI vision where there's tons of competition? I'm doing the classic thing. Is there still room for me in the venture world?
I would say definitely. I mean, from our perspective, we're looking for really big market opportunities and products that can provide really high ROI to those. So we're looking at a ton of stuff right now that doesn't necessarily leverage generative AI. Now, where I think it's important is if AI could provide an advantage to whatever application you're going after, and then there's a potential for a competitor to come in. But I think like it is not by any means a requirement for a product to include AI, depending on the application.
Only thing I totally agree. The only little nugget I would add to that is, I think if you're, and I don't know what stage you are, but if you are an early stage founder at that seed A level, you do have to discuss with the potential financial, like VC, about how you're thinking about technology and product in the future, and so that becomes a little bit of a test, in that conversation.
Yep, go ahead.
What current companies or technologies do you think will be rendered obsolete by generative AI?
Yeah, who's generative AI going to disrupt, and I guess particularly in the enterprise world? I'm adding that because of the focus, but no idea.
I mean, the easy answer is there's just a million startups trying to flood the opportunity, and as we've discussed at length on the panel, it's really the more existing, the Intercoms, the Notions of the world to capitalize. A lot of them are bolting it on, so I don't know if any, it's hard to think of an immediate name. Like systems of record aren't going away, workflows are workflows.
Yeah, it feels very early to me because everyone's applying it. We don't even know which of the startups are like effectively like productizing it. So it could be a ton of them, but I think we need to see sort of a really dominant offering before we know. Sure.
So my question is kind of post SVB collapse and also 2022 and 2023 Series A is kind of everybody's coming down, valuations. What do you see for seed? And also, are you like size of round and valuation of the round, but also are you looking for companies that have more revenue, more traction points, or where's your focus?
Yeah, so I guess I would, how financially insulated do seed companies need to be post SVB, especially like, do they need to be producing more revenue just to make sure they can survive on their own if they can't raise another round?
Yeah, I think, I mean, we can go down the line, but I think if you ask 4 people, you get 4 different answers. That's a reality. Sorry, I don't have a great answer.
If I'm understanding right, are the milestones changing for seed to raise the A? I think it's back to early 2020 pre-COVID where a lot of the infra stuff we do could be pre-revenue or when they're raising an A has maybe a first few early customers. I mean, because at the end of the day, they're building deep tech. Enterprise software is very tough to build. There's natural moats just inherently in building it, and especially if you're going in ML infrastructure or cybersecurity, like you take a lot to just even get those first proof points. And I'll say one counter. Sometimes people say, do you hit $1 million of ARR, $2 million ARR? Good investors that know certain categories don't use just ARR metrics. They want to know, is there a repeatable use case? Have you identified an ICP, an ideal customer profile? Have you found repeat with them? And in a design partner cluster, how are you going to go to market? What are you going to do with the money? There's a whole narrative that you have to build around it to understand, is there product market fit to scale with?
At seed or Series A?
So when we're investing at seed, we don't expect that. We want to know what's your story for it. We actually are publishing a template of our ICP doc where, we send it to founders when they're pitching us, and we're just going to publish it live so people could go through this exercise. What is my use case? What is my messaging? We want to know how people think, and then starting to have some proof points around that, whether it's customers, users, if it's PLG, different signups and whatnot for the A.
Yeah, like one of the things that we talk to founders about before we invest is understanding how well they know what they need to get to for Series A. So we're actually less looking for those metrics at our point, but we want to know, like, are you thinking about them and are you thinking about them the right way? Because I think like sometimes we get blanket answers like, oh, I'll get to $1 million ARR and then I'll raise Series A. And it's like, okay, is that true for your category? What do you think about repeatability? What kind of customers are you going to have? Like, we really want to see a lot of thought behind that.
Another question?
Sure.
So I'm a vertical SaaS founder, and I was curious to hear your guys' thoughts, and don't bias it based on I'm that founder, of what you think about vertical SaaS companies going after markets with smaller TAMs that are not in the $500 billion range, and how you
Yeah, that's a great question. So what's the state of thinking on vertical SaaS, especially for smaller addressable markets? It felt like there was a period where that was super cool. Is it still super cool, or just given the shrinking valuations, does everybody need to go after the whole market now?
Yeah, again, probably non-satisfactory answer, but we don't think about it that way. I think if we're not excited about, we're first excited about the founder story, kind of how they got to the idea. Then if we kind of keep clicking and the market doesn't feel interesting or feels too hard to kind of get through and too much permission, it could be a variety of reasons. Where like you could have it's not really about market size, it's like actually like ease of like getting in there, right? So there could be a large market, but actually how we think you would get into it would take years, or you would require so much permission. So it's really about that.
All right.
Time for one more.
One more question? All right, yeah, in the back.
How are you thinking about complex solutions with the services element?
The question is, how are we thinking about complex solutions with the services element? In a lot of enterprise, when you're selling Fortune 500, you ultimately do need some sort of deployment team. The question is, there's some VCs that will absolutely hate it. We just, at Workbench, our point of view is, if you start off maybe 80-20 split, that's okay, but we want to know that there's a sense to productizing parts of that. And then, there's always going to be some element of implementation, but don't make that your whole business and not have a product.
Yeah, we think a lot about the scalability of it. So, like, let's say early on you need a lot of implementation because you haven't built out your, like, some part of your onboarding, but over time that'll be there. And we think about, like, okay, well, when you are like 3 years down the road and you have like hundreds or thousands of customers, like, does this scale? So I think it's fine early on, but we're essentially investing in, like, at least at Cowboy, like, product software companies. So that should be something that that over time is not a huge part of your revenue.
All right, thanks everybody. We have survived the crisis, so hopefully things are fine. You know, this is a hard period maybe to fundraise, but always a good time to build a company. Thank you very much for taking the time. Thanks for coming.
Awesome. So thanks everyone for coming. We have networking time. We have the space for another hour. There's a bar here. There's also upstairs in the overflow space food. So everyone hang out, mingle, and thanks for coming.